In today's market, wealth is treated like a race to be won in a microsecond. Billions of dollars are aggressively piling into the latest artificial intelligence hype, driven by algorithms and traders trying to front-run the next daily news cycle. Take a look at this chart tracking how long investors actually hold on to a single stock. Back in the 1970s, the average holding period was 5 years. Today, that average has collapsed to a mere 10 months. This acceleration is fueled by the fear of missing out. People are actively trying to outsmart short-term volatility, jumping from one hot sector to the next the moment a stock dips. Modern investing has devolved from a practice of building actual business value into a psychological trap of impatience and noise. Against all that noise, you have 95-year-old Warren Buffett. Right now, he is quietly hoarding a record-breaking $400 billion in short-term treasury bills. To build that cash pile, he has been steadily slashing massive, previously untouched positions in some of the most successful companies on Earth, including cutting his massive stake in Apple by more than half. He has done this before. In 1968, when the market was obsessed with growth stocks, he closed his investment partnership entirely. He repeated this retreat in 1999, during the peak of the dot-com bubble. Both times, a brutal market crash followed. He operates on a very strict rule. If you cannot psychologically handle watching your portfolio value drop by 50% without panicking, you do not belong in the stock market. That $400 billion mountain of cash represents a rare level of psychological discipline, a refusal to participate in market greed, even when the crowd is getting rich. To survive the market, Buffett uses a strict mechanical filter called the circle of competence. You define exactly which industries you deeply understand, and you completely ignore the rest. Enforcing that boundary requires massive mental fortitude. When a new technology suddenly mints millionaires overnight, human nature screams at you to buy in. Staying inside your circle means actively turning your back on the hottest trends of the decade. Long-term survival relies less on knowing everything and entirely on mathematically defining and respecting what you do not know. When a business falls inside his circle, Buffett looks for an economic moat. This is the structural architecture required to protect a company's cash flow from brutal market competition. If you read through his recent 13F SEC filings, you can see exactly what he is still quietly buying while the rest of the market chases the tech sector. He is purchasing highly defensible assets. He targets companies with a low-cost structure or an intangible brand. A massive player like Chevron, for instance, operates at a scale and efficiency that guarantees pricing power even during brutal economic downturns. He also looks for high switching costs, recently buying stakes in media properties like the New York Times. Once customers adopt a sticky digital subscription habit, the hassle of leaving creates a nearly impenetrable barrier for competitors. These moats guarantee that a company is structurally immune to short-term market chaos. But an impenetrable fortress will still ruin you financially if you allow hype to dictate the purchase price. To find intrinsic value, investors estimate all cash the business will generate for its life, discounting it backward to find what those future dollars are worth today. Then, Buffett applies his margin of safety, demanding to pay only 80% or less of that value. That 20% mathematical discount acts as a psychological life jacket. It protects the investor from inevitable errors in human judgment and sudden market crashes. Selecting the right stock with a margin of safety is only the beginning. The actual creation of wealth requires the grueling psychological test of patience. Over his 60-year tenure running Berkshire Hathaway, the company has paid a dividend to its shareholders exactly once. It happened in 1967, and he later joked that he must have gone to the bathroom when the vote was taken. This curve shows the mathematical force of compounding. When decades of earnings are retained, protected, and reinvested back into the business, instead of handed out to shareholders, the growth turns exponential. Time is the actual engine of wealth, specifically the uninterrupted decades where you have the discipline to do nothing. Buffett is now stepping back from the microphone. In his final shareholder letters, he has outlined the quiet transition of power for the massive empire he built. His successor is Greg Abel. Abel earned the position by turning Berkshire's energy division into a highly stable industrial juggernaut with a reputation for efficiency.
Buffett selected Abel because he embodies Berkshire's specific culture of high trust and low costs.
In his final letter, Buffett explicitly praises Abel's integrity as the antidote to the salary racing and high-level corporate greed that typically erodes large firms. When the frantic tide of the market finally recedes, the fortunes left standing are those built on the specific traits Buffett modeled for 60 years: patience, discipline, and character.